Till now, we have understood various cash flow activities like your operating, investing, financing. Now we are heading towards ascertaining the cash flows from operating activity, then investing and financing. Okay, ascertaining the cash flow from operating activities. So, what I said, operating activities are the activities which are from your main source of business, and the revenue expenditure you incur for them is your operating activity. Therefore, it is very important to pay a special attention towards the ascertainment of operating activity. Okay, let's start. So, as per accounting standard 3, there are two methods which enterprise can follow. One is your direct method, other one is your indirect method. For your exam purpose, indirect method is applicable and we are also going to study the indirect method. Indirect method. What does it mean? Under indirect method, the format will be in lines with this slide mentioned here. Okay, let's start. Indirect method, the starting point, it begins with the amount of net profit, net loss, right? It is not that business will always earn profit. It can happen that business can incur losses also. So let there be a profit, let there be a loss, doesn't matter. If there is a profit, we'll take it as a positive cash inflow, and if it is a loss, we'll take it as a negative number. Okay, so the starting point under indirect method is your net profit. What net profit? Is it before taxes or is it after taxes? As told to you earlier also, operating activity is your meaning purpose of your business, right? So paying taxes on the profitability is also the operating activity, but as per accounting standard 3, we need to first take all the net profit which is before the taxes. Okay, so if in the question net profit is given after tax, you have to convert that after tax profit into before tax by adding back whatever taxes you have deducted while calculating net profit under your statement of profit and loss. Next, why we have to do addition, deletion or prepare a special account? Okay, because as per the accrual concept, we prepare the statement of profit and loss, okay, on the accrual basis and not on the cash basis. I'll give you one example. Salary. Okay, let's say salary is paid for 12 months, of which April to March month salary is outstanding. Okay, so in our accounting, as per accrual concept, since it has become due, we go and add the outstanding expenses, right? But under cash flow statement, we are only interested in actual cash inflows and actual cash outflows, right? So this part is important here, that we are not recording on the cash basis. Okay. Moreover, it includes non-operating items. Okay. So as told in financing activity, interest paid is your financing activity. But when you prepare statement of profit and loss, we don't bifurcate whether that interest paid is my operating activity or my financing activity. Why? Because we are only interested in knowing the profitability of the business and not knowing whether it is operating, whether it is financing or is it investing. Okay, so examples like your interest paid, profit and loss on sale of fixed asset, non-cash items. What are non-cash items? Depreciation, goodwill written off. Why depreciation is a non-cash expense? Let me explain you. See, why we charge depreciation? It is basically wear and tear of the machinery with time. The asset value get reduced, right? The asset value get reduced. We buy a mobile. In next 2 months, we feel that mobile should have been much better quality, right? We would have bought another mobile in same price. Technology obsolescence. Okay. So we charge the depreciation. But when we charge the depreciation, are we going to pay some cash to someone? Like we, in the case of salary, we are actually paying salary to the employees, right? There is actual cash outflow of the business. But in case of depreciation and writing of the goodwill, There is no actual cash outflow out of the business, although it is charged as expense in your profit and loss account. So since it is not related to cash and we are preparing cash flow statement, we have debited the depreciation to the profit and loss account. Debited means we have deducted that from the net profit element. So since it's not your cash item, we have to go and add back the depreciation charged in the profit and loss account. Okay, last. So it is very necessary to make the adjustment in the amount of net profit before you calculate cash flow from the operating activity, since all these items, non-cash items like your expenses which are of non-operating nature, since we are preparing the statement of profits and losses on accrual basis, we have to ascertain the cash flows of operating activity. Let's check the format for particularly preparing cash flow from the operating activity. So how do we prepare? Firstly, we write particulars, amount and amount. There is no debit column, there is no credit column. Okay, since it's a statement, understand when we prepare statement of profit and loss, when we prepare statement of balance sheet, do we see any debit or credit side? Answer is no. Same way, cash flow is a statement. So why do we have a debit and credit column? There is only two columns. One is amount, other one is amount. Okay, outer column and inner column. So let's understand what are the format for cash flow from the operating activity. It starts with net profit. Which net profit? It should be before taxes. And another thing which we have studied was extraordinary items. Right? Next, we need to adjust all the non-cash and non-operating items. So under non-cash item, one item I told was the depreciation. Then I told goodwill written off. Okay. Other than that, which are of non-operating nature, right? Interest paid is your financing activity. Loss on sale of asset is your investing activity. Interest dividend received is your investing activity. Profit on sale of asset is again your investing activity. So if they are not part of my operating activity, why would I add it to the net profit or deduct it from the net profit? Okay, so whatever you have debited or deducted from the net profit are to be added back. So depreciation, I have deducted. Interest paid, I have deducted. Loss on sale of asset, I have deducted. So I will go and add it back. Reverse is the case in case of income. Interest received, dividend received are the things I have credited to my profit and loss account, means added to the net profit. So I will be deducting it since they are not part of my operating activity. Till now, we have understood what are the operating profit before working capital changes. We will head now towards adjusting the working capital changes. Okay, so what is working capital firstly? Working capital is your current asset less your current liability. What are your current assets? Debtors, bills receivable, inventories, right? What are your current liabilities? Creditors, bills payable, right? You will say bank overdraft also, but in case of cash flow, we don't consider short-term borrowings. Bank overdraft is a short-term borrowings. Okay, so any changes in bank overdraft will not be considered here. We will be considering that in the financing activity. Since I told you, in case of borrowings, we don't make any difference whether it is short-term borrowings or is it long-term borrowings. Okay, let's see what do we do with the adjustment in the working capital. Okay, so if you will see, we add the current liabilities. Why we add the current liabilities should be your question. I'll give you a simple example. One of my current liability is my creditor. Okay, so when will your creditors get increase? When will your creditors get increase? Ma'am, it will get increase when I purchase goods on credit basis from the suppliers. Okay, so when I purchase, my stock or my inventory value will also go up. Inventories are my current asset. So by purchasing the goods on credit basis, what will happen? I will get more time for repayment. Cash is with me, as well as inventory value is also going up. When you purchase the goods, it is nothing but the inventory. Okay, so if it is going up, this will save cash with me. Okay, so whenever there is increase in current liability, I am going to add it, and whenever there is decrease in current liability, I am going to deduct it. When will the current liability decrease? When you make repayment to the creditors, suppliers. Okay, so whenever you make repayment to the creditors, suppliers, cash will go out of the business and working capital get reduced. So understand, if there is increase in current liability, you need to add it. If there is decrease in current liability, you need to deduct it. Reverse is the case in current asset. Okay, so if your current asset is getting decrease, I would say example debtor. If my debtors are getting reduced, means what? They are repaying me the money. Okay, so there is cash inflow. I will go and add it. And reverse, if my debtors are getting increased, when will my debtors get increased? When I do more of credit sales. So if I do more of credit sales, my debtors will increase, and in reverse, my stock will get reduced. So what will happen? My cash outflow is happening. I'm not getting money, but I'm giving goods on the credit basis to the customers. So cash outflow is happening instead of cash inflow. So I need to reduce it whenever there is increase in current asset. So to sum up, whenever there is increase in current liability, add it. Whenever there is decrease in current liability, less it. Whenever there is increase in current asset, deduct it. Whenever there is decrease in current asset, add it. And after adjusting the working capital, you get cash generated out of operating activity.